Hi everyone, my name is Nick Doyle. Today I'm going to talk about investing in bonds. I will answer 3 questions. The first, what are bonds? The second, why would you invest in bonds? And the third, how could you invest in bonds? So what are bonds? Bonds are essentially an IOU. You have what's known as an issuer, which could be a government or a corporation. They could be looking to raise money for a new project. So they might issue bonds to pay for it. They will borrow this money and promise to pay it back at a certain point in the future, which is known as the maturity date. They will also pay an interest rate because most investors want a return on their investment and to compensate for the risk they're taking in case they don't get paid back. This interest rate is also known as a coupon rate. The issuer will usually make payments for interest periodically. This could be annually, semi-annually, or monthly, and they will make these payments until the maturity date. And on the maturity date, they have to pay back the full amount. So let's say a city wants to borrow money to build a new bridge, and they need $1 million. So they might go out and issue bonds to investors for 10 years and offer to pay a 5% interest rate. So then each year they'll pay the investors the 5% coupon, and then at the 10th year they have to pay back the full amount. Bonds could be issued for as little as a few weeks up to even 100 years. Bonds are typically classified by the issuer, like government bonds or U.S. treasuries, which are issued by the U.S. government, or corporate bonds. And you also have junk bonds, which are issued by lower quality companies or risky governments. The interest rate on the bond will be determined by the issuer and their credit rating. The bonds themselves will be rated by third-party rating agencies. So you might have a AAA bond, which is issued by a very high-quality company or government, whereas a B bond might be issued by a low-quality company. So AAA bonds will pay lower interest rates usually than a B bond or a junk bond where there's higher risk involved. U.S. government bonds are typically even a level above AAA. They can just print U.S. dollars to pay back their debt. Bonds can be bought and sold on the market. So once the bond's been issued and investors bought it, if the investor wants their money back sooner, they could just go sell it on the market. The risk with this is, as interest rates change, the value of an existing bond will change. If you own a bond at a 5% interest rate and then rates go up to 6%, well, nobody wants to pay you back the full amount if you're selling the bond. You'll have to sell it at a discount in order to entice somebody to take the 5% rate because they're able to get a discount on it. Another important factor with bonds is called the duration. This is how sensitive a bond is to interest rate movements. A bond with a 1-year duration is much less sensitive to interest rate movements since you get paid back in 1 year, where a 10-year bond is much more sensitive since you have to wait 10 years before you get your money back to reinvest at new interest rates. When bonds are issued, they're often issued at different maturities. Like if a government's funding a project, they might issue bonds for 5 years, for 10 years, and for 30 years in different amounts to finance the same project. The bonds issued for 2 years will have lower interest rates than the bonds issued for 30 years. And this is because investors want to be compensated for the risk of investing for such a long period of time. This difference in interest rate based on the maturity of the bond is also known as the yield curve. Here's the current yield curve for U.S. treasuries. You can see the 1-month interest rate is 0.14%, where 30 years is 1.45. As you move from 1 month up to 30, that's the curve. This yield curve changes daily, and there have been points in times where it's been pretty flat, or there are points in the curve where it becomes steep. It's just good to be aware of what this yield curve is, because sometimes it might not make sense to loan money for a longer duration if you don't actually get a better return for doing so. So we saw how low the interest rates are on U.S. treasuries. So why would anybody invest in bonds? A lot of bond investors will typically buy bonds to de-risk their portfolio, or simply because they just have so much cash and they need a place to put it. If you're a corporation and you have $10 million, You can't just go give it to a bank, or you might not want to. You'd much rather give it to somebody like the US government, where you know you're going to get the money back and get a bit of a return. Some people will invest in higher interest rate bonds to try to get a better return on their investment, but a lot of investors are really just looking to do it for low risk scenarios or to decrease the overall risk in their portfolio. They will do this to diversify, since bonds often have a low correlation with stocks. As stocks go up, a lot of times the price of bonds are going down, but when stocks go down, like we just saw recently, bonds are actually going up and have had a really great year. Bonds are basically just like holding cash, but you get a better return. And you do have a little bit of risk in that if you have to sell the bond to actually get the cash early, you might have to sell it for a little less. You can insulate against this risk by buying shorter duration bonds whose prices won't change as much based on the interest rate changes. It can be good to have assets with lower correlation in your portfolio since they're going up and down at different times. This can provide volatility benefits where your portfolio doesn't swing as much as it otherwise would have. It also gives you a good opportunity for rebalancing. For instance, I hold 20% bonds in my portfolio. When bonds have a good year, like this year, I actually sold some bonds and bought stocks at a discount. So I was able to buy stocks low and sell my bonds high. And the inverse goes true. When stocks are doing very well in the year and bonds aren't doing as well, I sell stocks and buy more bonds. I maintain that 80% stock, 20% bond allocation, and I rebalance once per year. This will lower the overall volatility in my portfolio and give me the opportunity to take advantage of the benefits of this rebalancing. Now, some people will just invest 100% in stocks and not have any bonds. They typically return higher overall, but I like having a little bit of bonds on my portfolio for this rebalancing effect and just minimizing some of the volatility. There have also been decades where bonds have outperformed stocks in the past, so who knows what's going to happen in the future. Many investors, as they age, will increase the number of bonds in their portfolio. There's a rule of thumb known as age in bonds, and this is where the recommendation is to hold a percentage of your portfolio in bonds that's equivalent to your age. So if you follow this rule, if you were age 30, maybe you would have 30% in bonds, and if you're age 70, you might have 70% in bonds. The reason for this is as you get older and you retire, you're probably going to need the money from your portfolio. Stocks are fairly risky, and when you go to get your money, there may be a 50% market drop. You wouldn't want that to happen. You would much rather have bonds, which are a much more steady return and very low risk of losing any of the original principal. So this is why investors, as they age and approach retirement, they have much more in bonds since they can rely on that being there when they need to pay their bills. Another risk with bonds is the interest rate might actually be lower than the inflation rate. So you might actually get paid less money in the future than the current value of the money now. This is especially a concern right now, as we saw the US Treasury rates are so low. And in some countries, interest rates on bonds are actually negative, where investors are paying a government like Germany to hold their money for 10 years. This sounds crazy, but it's actually happening, and there are trillions of government debt right now at negative interest rates. Now, I've talked about a couple of the risks, like the issuer risk where they might go bankrupt and not be able to pay you back, or interest rate risk where rates change and you can't get the original amount back if you need to sell your bond, or inflation risk. There are also currency risks and many other risks. You need to do your research and be aware of what these risks are. Don't rely on me because I am not a professional and this is for entertainment purposes. But with that said, if you want to buy bonds, you determine the risks are right, you want a certain amount in your portfolio, maybe you're following age in bonds, maybe you're doing something different, whatever makes sense for you. But let's say you've decided you want to purchase them. How would you go about doing that? One option, you could go right to the US government website, Treasury Direct. The US Treasury lets you buy bonds directly from them, and they don't actually charge a fee for doing so. You could also buy bonds from a broker like TD Ameritrade or Fidelity. They sell all sorts of different bonds at different durations. Just like stocks, you could go there and buy all sorts of bonds. Well, I could go out and buy individual bonds. I'm too busy smashing like buttons for the YouTube algorithm. I don't want to have to remember to go reinvest my money at a certain date. I don't want to determine, do I buy a 2-year bond, a 5-year bond, a 30-year bond? How many bonds do I buy? Which company's bonds do I buy? This is all too much hassle. I really need to be able to focus on smashing all those like buttons. My favorite way to invest in bonds is through a bond index fund. These are products sold by companies like Vanguard or Fidelity, where they will let you buy one product that invests in hundreds or even thousands of bonds. There are all sorts of bond index funds. There might be a US government bond index fund, a mortgage bond index, a corporate bond index, a junk bond index, an international bond index. And there will even be variations of these, like a short-term US government bond index, an intermediate-term US government bond index, a long-term US government bond index. There are all different types of bond indexes. And my favorite is the total bond index. This will just take all the bonds issued in the United States and basically invest your money in a representative portion of all of them. The great thing is you don't have to do anything. They will automatically invest in all these and just make you the monthly payment. They charge almost nothing for doing this. The Fidelity Total Bond Index is 0.025%. That's 0.02%. That is basically nothing considering you're investing in thousands of different bonds. This total bond index is usually around a 5 to 7 year duration, which I think is reasonable for most investors that don't want that much risk. However, make sure you're comfortable with the risks that these funds have. You can look at their prospectus. Well, let's just take a quick look at the Fidelity Total Bond Index, FXNAX. This is actually the fund I have all of my bond investments in. You can see in the recent crisis we've had, this bond has actually returned 6% year to date. And this is because interest rates were higher and now they're lower. So as interest rates go down, the value of the existing bonds at higher rates go up. So the value of the bond fund actually went up because of the rates going down. And you can see over 10 years it's returned almost 4%. You can see the portfolio diversification where you have 43% US Treasury, 24% in corporate, 25% in MBS, which is mortgage-backed securities. And then you can see the interest rate sensitivity and credit quality. You have high credit quality, moderate interest rate sensitivity. You can see the top 5 issuers, that it has 2,123 different bonds from 546 issuers. You can see the credit quality breakdown. 70% of the bonds are guaranteed by the US government. Now, the US Treasury is the largest one, but you also have Fannie Mae, FNMA, or Ginnie Mae, GNMA, and you would also have Freddie Mac, which is FHLMC. These are different agencies that guarantee mortgage bonds, and the US government actually backs them up and guarantees to pay investors back if those bonds default. This fund has an overall duration of about 5.5 years, and then you can see the different breakdowns there. So you can look at these fund details in the prospectus to learn more and judge if the risks are something you want to take and invest in. But this is basically a one-stop shop for investing in bonds. You're effectively getting exposed to the entire US bond market by buying this one fund. The fee is so low at 0.025% that you're basically paying nothing for this fund. The Vanguard equivalent of this fund is also really good. These are both great funds. I think either of them would be great in anybody's portfolio. So we talked about what are bonds, why you might want to invest in bonds, and how you could invest in bonds. Just remember, to make your own decisions, do your own research, and figure this out. I'm just sharing my thoughts, my opinions, trying to be a little entertaining, and showing you what I'm personally doing. Thanks for watching. I hope you learned something about investing in bonds. Don't forget to comment below and smash the like button, and then subscribe so my future content lands in your inbox. Later.